Section 1. In the history of finance, the most dangerous asset is rarely debt itself, but rather the unbridled capitalization of imagination. When a nation's entire solvency relies entirely on the projected earnings of a territory it has barely mapped, the line between visionary monetary policy and catastrophic fraud dissolves. We usually assume money is a store of tangible value. History proves it is often merely a consensus hallucination. Now, let's open the ledger and audit the system that determined the cost. To understand the autopsy of the Mississippi bubble, we must first examine the patient's condition prior to the intervention. In 1715, following the death of Louis XIV, the Kingdom of France was not merely broke, it was functionally insolvent. The Sun King had financed decades of warfare through aggressive borrowing, leaving the treasury with over 3 billion livres in debt, a sum so staggering that the annual interest payments alone exceeded total tax revenues. The metallic currency system had seized up. Gold and silver, fearful of arbitrary devaluation by the crown, had gone into hiding, leaving the economy starved of the liquidity required for basic commerce. When we audit the royal accounts of this period, we see a balance sheet in cardiac arrest. Liabilities were absolute, while assets were illiquid or non-existent. Into this fiscal void stepped John Law, a Scottish theorist and mathematician who viewed money not as a commodity like gold, but as a functional tool of exchange, a system of confidence. Law correctly diagnosed that France's problem was not a lack of wealth, but a lack of velocity. The economy was paralyzed because the medium of exchange was too scarce. His proposed remedy was radical: the introduction of a paper currency unconstrained by the slow mining of precious metals, which would grease the gears of trade and restore tax revenues. Law's initial implementation was clinically sound. He established the Banque Générale in 1716, issuing paper notes backed by silver. These notes traded at a premium to the debased metallic coins because they were accepted for tax payments. For a brief moment, the system worked. Liquidity returned. But Law's ambition was not merely to fix the currency. It was to liquidate the royal debt entirely. To achieve this, he engineered a financial consolidation that remains one of the most complex restructuring efforts in economic history. He acquired the dormant charter for the Compagnie d'Occident, Company of the West, and granted it a monopoly on trade with the French territory of Louisiana, the vast, undefined basin of the Mississippi River. The genius and the eventual poison lay in the capitalization structure. Law allowed investors to purchase shares in this new company not just with gold, but with state bonds, billets de tête. This was the alchemist's balance sheet in action. The public held government debt that was trading at a deep discount, worth perhaps 30% of its face value due to the risk of default. Law offered to accept this junk debt at full face value in exchange for shares in the Mississippi Company. For the holder of the debt, it was an arbitrage of a lifetime. Trade a depreciating government IOU for an equity stake in a company that owned half of America. From a forensic perspective, this operation was a massive debt-for-equity swap. Law was essentially privatizing the national debt, converting fixed-income liabilities into variable return equity. The French government's crushing interest obligations were wiped off the books, replaced by the company's promise to pay dividends. However, for this balance sheet to balance, the assets side, the Mississippi Territory, had to hold real value. The entire valuation of this debt-clearing mechanism rested on the assumption that Louisiana was not a fever-ridden swamp, but a land teeming with gold mines and emeralds comparable to Spanish Peru. Law was monetizing theoretical colonial gains. He was booking revenue that did not yet exist to service debt that very much did. The ledger was clean, the debt was moving, and the shares were issued. The machine was primed, but it required a continuous supply of liquidity to keep the share prices rising, lest the investors realize they had swapped bad debt for a mirage. Section 2. By 1719, John Law had achieved what modern central bankers can only dream of: the total fusion of monetary policy and fiscal stimulus. However, the mechanism he constructed to sustain the Mississippi Company's valuation was not an investment engine. It was a machine built for infinite leverage. To diagnose the inevitable cardiac arrest of this system, we must audit the structural changes Law implemented when he converted the Banque Générale into the Banque Royale. This was not a mere change in nomenclature. It was a fundamental alteration of the currency's DNA. Previously, banknotes were backed by the bank's reserves. Now they were guaranteed by the king. In practice, this removed the hard constraint of metal reserves on the money supply. With the printing press unleashed, Law initiated a sequence of share issuances, known historically as the mère, mothers, filles, daughters, and petite filles, granddaughters, that absorbed the remaining public debt. When we strip away the period costumes and examine the plumbing of these transactions, we see the prototype of a margin loop. To ensure the shares were fully subscribed, the Banque Royale began printing money specifically to lend to investors. The terms were staggering. A citizen could borrow notes from the bank to purchase shares in the company, pledging the shares themselves as collateral. This created a fatal circular dependency in the national balance sheet. The bank was printing currency to inflate the value of the company, while the company's rising share price was used to justify the solvency of the bank's loans. It was a closed loop of liquidity, untethered from the real economy. The system incentivized higher prices, not productivity. As long as the share price rose, the collateral was good, and the loan was safe. The psychological impact of this mechanism on the streets of Paris was immediate and violent. The Rue Quincampoix, a narrow street housing the company's offices, became the epicenter of the first true financial mania in recorded history. The demand for paper wealth was so intense that hunchbacks reportedly rented out their backs as writing desks for frantic traders signing contracts. We must understand the scale of this distortion. The shares, originally issued at 500 livres, skyrocketed to 10,000 livres within months. The market capitalization of the Mississippi Company reached levels that, relative to the size of the French economy, dwarf the valuations of the dot-com bubble or the 2008 housing peak. The term millionaire was coined specifically during this period to describe the servant class who, through lucky speculation, found themselves wealthier than the landed aristocracy. However, a forensic audit of the company's internal ledger reveals the rot beneath the gilding. A stock price is theoretically the present value of future cash flows. At 10,000 livres per share, the market was pricing in a dividend yield that would require the Mississippi Territory to produce more gold and trade goods than existed in the entire known world. The reality of Louisiana was starkly different. While Paris traded paper claims on colonial paradise, the colony itself was a desolate expanse of swamp and struggle. There were no gold mines. The colonists sent to generate this wealth were often emptied out of French prisons, vagrants and criminals forced onto ships to provide a headcount for Law's reports. The extraction of tangible value was near zero. The company was paying dividends not from profits, but from new capital raised from new investors. The textbook definition of a Ponzi scheme operated at the sovereign level. The turning point, the onset of the systemic cardiac arrest, arrived when the phantom liquidity leaked out of the stock market and into the real economy. This is a critical mechanic in hyperinflationary events. As long as the printed money remains trapped in the asset market, buying shares, consumer prices remain stable. But eventually, speculators seek to realize their gains. They sell their paper shares to buy land, jewelry, estates, and food. In late 1719, savvy operators, including the Prince of Conti, began to calculate the math we are looking at now. They realized the volume of paper claims, banknotes and shares, vastly exceeded the metallic reserves of the kingdom. They started quietly cashing out, bringing wagon loads of paper notes to the Banque Royale and demanding gold in exchange. The ratio of paper to specie, metal, had exploded. When we reconstruct the monetary aggregate, we estimate that the face value of paper notes in circulation was 4 times larger than the coin supply. The system was leveraged 4 to 1 on a reserve base that was rapidly fleeing the country. Law's response to this liquidity drain was not to tighten credit, but to double down on coercion, a desperate attempt to alter the laws of economics by royal decree. He criminalized the ownership of gold. The state empowered inspectors to raid homes, searching for hidden coins. In a final fatal move to protect the share price, Law pegged the value of Mississippi shares to the banknotes at a fixed rate of 9,000 livres. This was the death blow. By pegging a volatile asset, shares, to the currency, Law effectively monetized the entire stock market. Anyone who wanted to sell their shares could simply walk into the bank and receive 9,000 livres in fresh banknotes. The money supply didn't just expand, it went vertical. The printing presses of the Banque Royale ran day and night to honor the peg. The result was not wealth, but the annihilation of the unit of account. Monthly inflation roared to 23%. A loaf of bread that cost pennies now cost a fortune. The public trust, the only true backing of a fiat currency, evaporated. The velocity of money became infinite. No one wanted to hold the notes for a second. They traded them for anything tangible: furniture, candles, land. The engine of infinite leverage had thrown a rod. The feedback loop reversed. As confidence fell, people sold shares, forcing the bank to print more notes to maintain the peg, which caused more inflation, which killed confidence further. The autopsy of this phase reveals a market mechanism overwhelmed by its own efficiency. Law had built a system designed to pump liquidity into the market, but he had installed no brakes to stop it. He failed to distinguish between money, a store of value, and credit, a promise to pay. By treating them as identical, he allowed the liability side of the nation's balance sheet to consume the asset side. The patient was technically alive, the presses were running, the market was open. But the brain death of the currency had already occurred. Section 3. The collapse of a financial bubble is not a random accident. It is a mathematical inevitability, a violent regression to the mean. In the summer of 1720, the French economy underwent what we in forensic analysis call a correction of reality. The sheer weight of the phantom liabilities created by the Banque Royale finally crushed the structural integrity of the state's credibility. The catalyst was a single administrative error that shattered the collective hypnosis. On May 21, 1720, realizing the impossibility of maintaining the peg between the ballooning paper currency and the plummeting metallic reserves, John Law issued a fatal edict. He announced a phased reduction in the value of shares and banknotes, essentially devaluing the currency by 50% to align it with the reality of the reserves. It was an act of honest accounting, but in a confidence game, honesty is a death sentence. The public reaction was not merely economic, it was visceral. The illusion that paper was as good as gold evaporated instantly. The correction arrived in the form of a deadly bank run. Crowds numbering in the thousands besieged the Banque Royale, not to invest, but to salvage. The panic was so physical that on several occasions over a dozen people were crushed to death in the stampede to convert paper into anything tangible: silver, copper, even food. The velocity of money, which Law had engineered to stimulate the economy, now acted as a centrifuge, spinning wealth out of the system faster than it could be measured. When we audit the final collapse, the numbers are sobering. The Mississippi Company shares, which had touched the stratosphere at 10,000 livres, entered free fall. By late 1720, they had lost 97% of their peak value. The paper bank notes fared even worse. Merchants refused to accept them. The government, in a reversal of policy, demonetized the notes, rendering billions of livres in paper wealth worthless overnight. The ledger had balanced itself in the most brutal way possible, by writing down the value of the liabilities to zero. The systemic autopsy reveals that the mechanism of failure was the decoupling of price from value. Law believed that by controlling the supply of money and the price of shares, he could manufacture national wealth. But the market proved that price is merely a signal, while value is a product of utility. The Louisiana territory remained a swamp regardless of the share price. The paper notes remained ink and rag, regardless of the royal stamp. When the volume of claims, the notes, exceeded the productive capacity of the underlying asset, the French economy and its colonies, the currency hyperinflated to bridge the gap. John Law fled France, destitute, eventually dying in Venice. A gambler who broke the house, only to find the chips were counterfeit. France was left scarred. The trauma was so deep that the French vocabulary for finance was permanently altered. For nearly a century afterward, the word bank was considered a vulgarity, replaced by case, box, or credit to avoid invoking the ghost of 1720. The experiment delayed the modernization of the French financial system for 80 years, leaving the monarchy fiscally crippled and setting the long-term stage for the revolution that would eventually claim the heads of the system's successors. We close the ledger on the Mississippi bubble not as a tragedy of greed, but as a lesson in the physics of value. John Law proved that while a central authority can print currency, it cannot print productivity. Wealth is not the number on a balance sheet. It is the tangible goods and services that the number can command. When finance forgets this distinction, the market will always, eventually, correct the error.